Today, we are going to understand credit VaR models, starting with Vasicek's model, which is one of the most important models under the Basel IRB approach. Vasicek's model uses a Gaussian Copula framework to estimate the worst-case default rate at a given confidence level. In simple terms, it tells us how bad defaults can get in extreme conditions. The key formula is WCDR T x equals n PD plus square root rho times n x square root 1 minus rho. Here, PD is the probability of default, rho is asset correlation, and x is the confidence level. Once we calculate WCDR, we estimate total portfolio loss using total loss approximately equals sigma WCDR times EAD times LGD. The important intuition is that higher correlation increases the chances of extreme losses, but a limitation of this model is that it does not capture tail dependence properly. Now moving to the credit risk plus model, which takes a completely different approach. Instead of market-based modeling, it uses actuarial techniques. If defaults are independent, we use the binomial distribution. However, when the portfolio is large and default probabilities are small, we simplify it using the Poisson distribution. But in reality, default probabilities are not constant, so we introduce uncertainty using a gamma distribution. This leads to a negative binomial distribution. The key idea here is that as uncertainty increases, the probability of large numbers of defaults also increases, meaning the loss distribution becomes fat-tailed. Next, we have Monte Carlo Simulation, which is not a model itself but a powerful technique used across credit risk models. Instead of assuming fixed relationships, we simulate thousands of scenarios. This helps capture the fact that defaults are not independent across time. For example, if defaults happened last year due to economic stress, they are more likely this year as well. As uncertainty increases, default correlation rises, and the loss distribution becomes positively skewed. This makes Monte Carlo simulation extremely useful for realistic credit VaR estimation. Now let's talk about the CreditMetrics model. Unlike Vasicek and Credit Risk Plus, this model considers not just defaults but also credit rating migrations. It uses a transition matrix to estimate how credit ratings change over time. Then, using Monte Carlo simulation, it calculates the value of assets under different rating scenarios. The credit loss is calculated using credit loss equals sigma 1 minus R times Q times V, where R is recovery rate, Q is probability of default, and V is exposure value. A unique feature of CreditMetrics is that losses can even be negative if a borrower's credit quality improves, which reflects real market behavior. Finally, we have the correlation model, which extends these ideas by explicitly modeling correlation between firms. It assumes that credit rating changes are driven by underlying correlated variables using a Gaussian Copula. We convert rating transition probabilities into normal thresholds using inverse normal values like n 0.0003 equals minus 3.3416, and then simulate correlated random variables. Depending on where the simulated value falls, we determine the rating outcome. This approach captures systematic risk, meaning multiple firms can deteriorate together during economic downturns. So overall, Vasicek focuses on worst-case default rates, Credit Risk Plus models default frequency statistically, Monte Carlo adds realism through simulation, CreditMetrics captures rating migrations, and the correlation model brings independency across firms. Together, these models form the foundation of modern credit risk measurement and credit VaR estimation.